However, a recording will be made available as soon as possible after the meeting has concluded. We welcome the use of the Welsh language at meetings. Excuse me. I've had no requests for people to speak Welsh today, so this meeting will be conducted in English only. Please can members attending via Microsoft Teams refrain from using the chat function and instead use the raised hand icon to indicate when you want to speak. Please remember to keep your microphone muted when you're not talking. And with that, moving on to the agenda. Agenda item number 1, attendance and apologies. Geraint.
Thank you, Chair. I've got apologies from Councillors Gordon, Simons and Tew.
Thank you very much. I think that accommodates everybody. So agenda item number 2, declarations of interest. Geraint.
Thank you, Chair. I'll just go through the members now, and if you can just let me know that I've got your declarations correct, that'd be great, thanks. If I can start off with Councillor Haller, please. I've got that you are a contributor to the... Councillor Williams, I've got that yourself and your wife are contributors, and yourself and your wife are also in receipt.
Correct.
Thank you. And lastly, Chair, I've got that you're a contributor, and that your father and 2 other family members are in receipt.
That's correct.
Thank you. That's everybody, Chair.
Thank you very much. Just before we continue, actually, I'm aware we have somebody on Teams joining us today. It says SVC Teams. Could you please just confirm who you are, so we know in the room who's on the call, please? Or maybe not. Geraint, could you send them a message on Teams so we can just get confirmation who they are? Thank you very much. Thanks. Item number 3, minutes of the Pensions Committee, the 12th of December 2022, for members to raise issues and agree the minutes. Do any of the members of the meeting have anything they'd wish to raise off the back of the minutes? David, no. John? No, neither would I. In which case, the 3 of us can formally agree the minutes. Agreed? Yeah, fantastic. Gareth, if you could note that. Agenda item number 4, and these are for information only. We've got the draft minutes of the Pension Board meeting of the 25th of January 2023. So that's, like I said, for noting only. So moving on, some substance. Agenda item number 5, we have the Pension Fund budget for 2023-24. Alex, over to you.
Thank you, Chair. Morning to members, both in the chamber and who've dialed in online. First item today then to discuss is the pension fund budget for, primarily we're going to talk about the 23-24 financial year to come, but the report does touch on the sort of the final forecast position for 22-23 as well. So I'll just by way of background really for members' benefit, the pension fund, although a completely separate budget, prepares every year in line with the local authority, basically a forecast looking forward of the income and expenditure for the year ahead. We use the same professional discipline in terms of the way that we budget on a prudent basis, and in doing so have to make a number of assumptions. And I'd say that's some of the key differences between the two. I think the purpose of this report is to give you that update and essentially ask you to approve the revised budget for the year ahead. I think when I talked about some of the key differences, mainly from an income perspective, clearly the majority of the fund's income comes from contributions. That's employee contributions and employers, so all of our members pay a fixed level that's set by government, and then employers pay a rate which is set essentially by the fund via the advice of the actuary. And the remainder of the income comes from the investments, some of which is reinvested automatically, which I'll touch on a little while. I think what's fair to say is that although we can make a reasonable assessment of income coming into the scheme, it is very dependent on membership numbers that could fluctuate year on year, and clearly the investment income is often driven by the performance of those assets. So that sometimes has a degree of uncertainty as well. Clearly, the primary role of the fund is to pay pension benefits to its members, so that's predominantly the largest part of our expenditure. Again, that is often linked to the decisions of underlying members, so we make a best estimate forecast based on prior experience. And perhaps what sort of trends the actuary may suggest we could see in terms of more members moving to retirement. The other big expenditure item is related to investment management expenses, which clearly on a 3.7 billion fund are quite substantial. Another key factor which has become a bigger issue in more recent years is inflation. As members should be aware, LGPS benefits are linked to CPI, and in particular that's the September value CPI is applied for the following April. So in the case of 2023-24, the September 22 value of 10.1% will be applied to those pension liabilities, increasing those costs, which obviously has a direct impact on the fund's expenditure. There is also an impact on the career average earnings as well for current members, with an upward revaluation there. So again, that will contribute to the longer term liability, although perhaps not seeing that in terms of an annual expenditure increase. Other major factors which do have a bearing or present some uncertainty when trying to set the budget is central government policy. Members will be familiar with the issues of McLeod, but also things like the cost cap mechanism, which can influence the cost of liabilities. Again, will provide some uncertainty around our expenditure, and something that we make a best estimate in terms of factoring in. The final point, and we'll hear more about this throughout the agenda, is the macro environment or the market volatility and the impact that could have on investment performance, whether positive or negative. As I said, investment management fees are linked to the value of our investments, and so when they perform well, fees typically go up, and when they don't perform so well, we may see a reduction in those fees. So again, we make a best estimate basis. I think probably just the one point to highlight before we get into some of the detail is that in terms of the key assumptions, we haven't made any assumptions over material changes to the strategic asset allocation for the year ahead. That is often quite difficult to assume with timings. What I would say is I wouldn't expect that to have a significant impact on the level of fees that are paid, which would be the key driver around that anyway. We've assumed that the LGPS membership will remain fairly typical, fairly static, with only the sort of prior year trends in upward, increasing members and pensioners. And actuarial assumptions, which typically we take are revised every 3 years as part of the triennial evaluation. We will have seen those updated to reflect the 2022 process that we've just gone through, so they are what I would consider to be up to date. I think just turning to the report itself, just to cover a couple of points, and referring to page 34 of your papers. Clearly, part of an important aspect of the pension fund's budget and the management of its responsibilities is to ensure a cash management strategy is in place. The fund has a strategic allocation of 1% or up to 1% towards cash. That is intended to meet the day-to-day obligations, primarily paying pension benefits, but also like investment management expenses, paying to administer the scheme, etc. The process is of the cash management process is undertaken by the Torfaen County Borough Council's Treasury Management function, and we also utilise the external brokerage advice that they receive as well. So we're comfortable that process is carefully managed. There's been no major change to that process in the year that has gone. Clearly, the interest rate environment and rising rates has had some benefit from income on those investments, although we don't consider that substantial enough to sort of change the tactical allocation or the strategy there. So we continue to hold enough cash to meet operational requirements, but worth just noting that. I think page 35 is probably the one just to sort of highlight, really, to put some of the context into the numbers. Just starting from left to right, obviously the table highlights the 21-22 position, and then moving to the right, the third and fourth columns reflect the current financial year to the end of this month. The original estimate would have been what we presented to the committee this time last year, and the fourth column across there, the revised estimate, is essentially the most up-to-date position as of the end of February. As you can see, generally the trend, the upward trend in both income and expenditure has played out. Just to pick up on one or two of the bigger items, really, is the employer contributions. You can see that figure was originally estimated 142. It's gone to 153 million, and subsequently the forecast for the 23-24 financial year is 161. That primarily is driven by pay awards, which were much larger than anticipated this time last year. Clearly, the impact of a pay award means that members, the percentage contribution that members pay would increase. That also has a knock-on effect to the scheme employer, who's subject to paying contributions as a percentage of their overall payroll levels. But also, there's some planned increases to the scheme employer contributions that are paid as a percentage, and that was agreed at the 2019 valuation. So the current year that we're in is the final year of those 3 years of rates. For 23-24, we've made an estimate that the increased pay award, that sort of what we're seeing from the cost of living, would be expected to provide a further income from that perspective. Of course, we would have to meet pension payments, and as I mentioned at the start, inflation is having an impact on those liability costs. So it's not a case of income is disproportionately increasing relative to the expenditure. We would expect both to be increasing. And in fact, that's what you sort of see on the expenditure as part of the bottom half of the table. Income earned on investments, I'm just turning to the final point in the income section. This is typically the dividend income that the fund benefits from all of its underlying investments. I think the point I would make here is that for the vast majority of that income, it's automatically reinvested. So there is not necessarily a cash flow impact here. We don't physically benefit from the income coming back into the scheme. Instead, that's often automatically reinvested into the value of the assets we already have. That being said, there is a proportion of that income that does come back, and that's set out a bit more detail in the report. Just turning to the expenditure side, as I've already mentioned, pension payments are expected to be increasing, linked essentially to inflation, and also the pay award impact that will have. There are some sort of what we would consider more one-off or very difficult items to forecast, things like lump sums. That is very much driven by member decision to retire. Very difficult to forecast, and we typically we use the prior year experience to base that forward-looking expectation. The largest item that I would particularly draw on in the expenditure is, again, management expenses. For the financial year that we're currently in, 22-23, clearly market volatility has seen the value of the fund generally move downwards, although we've seen some recovery there. And we'll touch on that later in the agenda. So the management expenses for the year were lower than anticipated. But what we would expect this year, we've made an assumption linked to the actuarial assumption of 4.4% as the future growth of the fund's investments. We've assumed that would link to the AUM, and therefore the management expenses would rise in line with that. I think ultimately the important point to note, the bottom line means that we're still forecasting an income surplus, if you like, although albeit within that 56 million quoted in the bottom right-hand corner of the table, a large proportion of that is not a cash flow item as such, it's reinvested income. Within the report, it's noted there's around a 17.5 million net inflow from a cash flow perspective. Clearly, that's it. We're in a good place there. It's not the case for all local government schemes that they are cash flow positive. The impact, if that cash flow positive figure was to fall, would be potentially having to realise assets to meet obligations, and that then becomes a different sort of challenge, I suppose. So it's pleasing to say we're not in that place. I don't think I need to spend too much more time. Essentially, the remainder of this report provides a lot more detail behind what I've raised. I think on the bottom of page 37, there's another table, much more summarised. This is in line with SIPA requirements. This is something we would disclose in the annual report and accounts. And essentially what this shows is all of the fund's costs broken down by three categories. Admin is essentially to administer the scheme. Majority of that cost would be staff internally, the software that we use to run the pension system, and all other costs associated with that. Investment management expenses essentially is the cost of managing the 3.7 billion fund. And oversight and governance, which is an important aspect of the fund's activity, is essentially overseeing and making sure that those decisions are taken in an appropriate manner. So that includes things like our advisors' costs, training expenses, but predominantly the WPP as well as the pooling entity. There's substantial cost associated with that, which we feel does deliver good value, but nevertheless it has to be disclosed. So you can see that the pension fund budget forecast for the year ahead is not substantially ahead of where it was last year. In the majority of cases, we're seeing moderate increases linked to things like inflation and cost of living. We've seen some one-off items, particularly in in the investment management expenses that were incurred last year that we wouldn't expect in the year ahead. So that actually presents on the face of it a small saving on the fees. Clearly, we would also expect any further transition activity to deliver savings on investments, which would hopefully bring that cost down proportionately in the context of the value of the fund. I think I may pause there unless there are any questions. Otherwise, I think perhaps it would be worth turning to the recommendations, Chair.
Thank you, Alex. John or David, any thoughts or questions? John? No, David.
Thank you, Chair. Very clear, Alex, in terms of detail of behind some of those figures. I guess, the thing that hit me was probably the headline figure at 6.1, where the 21-22 actual 26.5 profit, as it were, or in surplus, compared to 56, which is pretty much doubled in a couple of years, which would seem to suggest that perhaps the sort of market volatility that we experienced last year has evened out quite a lot, and it was helpful to see the table that you put in at 7.3, I think, which you've shown some of that as well. I guess it's helpful to get some feel, though it's not really appropriate for this report of the budget, I can understand that, of what that looks like in terms of a longer trend. Yeah, very comprehensive, and I would move that we accept the budget because it's all very clear.
And before you come in, Alex, I think I just want to reiterate what Councillor Williams has said. I found it a very clear report. It's very, and bearing in mind some of the conversations you were having last September, it's very encouraging to realise the extent to which we bounced back from, which for us was a minor ripple compared to many private pension funds and the rest of the market. So I think actually it's a testament to sort of the very many years of good management of the fund, I think, by staff members here at Torvine. So again, I'm more than happy to move the recommendation that we accept the budget for the next calendar year. David, John, do you agree? Excellent, that's 3 out of 3. So that's carried. That's overblown way of putting it, if you know what I mean. We've carried the votes, the budget's been set. Okay, fantastic. Item number 8 then, still with Alex. We have the quarterly investments performance. Oh, I've moved on, sorry. Item number 6 is the funding strategy statement. Alex.
Yeah, thanks, Chair. So I think probably the place to start with this update is that the funding strategy is one of 4 statutory policies that the fund must maintain. And one of the key roles of the committee is to approve the strategies in line with regulations, if you like, and obviously advice of officers and advisors. We've already touched on it briefly and throughout previous agendas, but the 2022 has been an important year from a triennial evaluation perspective. Essentially, a funding health check of the pension scheme has been undertaken by Heinz Robertson, who are the fund's actuary, alongside the rest of the LGPS, particularly in England and Wales. That process is substantially now completed. We are in the very final stages, one of which of the remaining tasks is to have the policy agreed. And the purpose of this update is to provide you with an overview of that policy and the changes within, which would then ideally be published by the 1st of April, or by the deadline. I think, as I say, I've sort of covered off many of the key messages there. I think probably the points I just wanted to highlight from the purpose of this policy, essentially it is to set out how the fund funds its liabilities, and we can do that in 3 ways, 3 income drivers, and we've just touched on them within the budget, but essentially the employee contributions, they're set by central government and are outside of the fund's control. Employer contributions, these are what are directly within the fund's control, based on the advice of the actuary. And investment income is the 3rd income flow that can support the payment of our liabilities. But clearly, as we just talked about, the volatility of investment markets more generally means that being able to place any real degree of reliance on investment income is quite a challenge. I think the point to emphasise is that the real lever that the fund has under its control is employer contributions, and that's really what this policy focuses on in terms of how it funds its liabilities. As I say, the policy's been revised. There's a lot of detail within the report, and within the appendix specifically is you have the updated policy, which is what we're essentially asking members to approve publication of today. I think that there's a couple of sections in there. There's section 2.2 of the funding strategy statement. If you just give me a second, I'll find the page reference. So I think that's on page 52 of your papers. Although quite a detailed and technical section, this really summarises the approach that the fund via the actuary takes in setting the contribution rates for each of its scheme employers. Obviously, there's a range of employers participating in the schemes. We've got a lot of sort of low-risk tax-raising long-term bodies such as local authorities and police authority. We've got colleges, universities. Then we've got a number of community admission bodies and other sort of admission bodies that participate as they provide a form of local government service at arm's length to an original body, if you like. So there are a number of factors that are taken into consideration by the actuary. The purpose of this section really is to inform the employer of the approach that would be taken in balancing that risk and trying to obviously provide the level of contributions that we provide is supposed to balance the needs of the fund with the challenges and the affordability of the employer in the long term. I think probably that's the only point I would really draw on here. I mean, the FSS sets out a number of risks as well, which clearly we are mindful of in setting the process. I'm certainly comforted by the extent of support that we receive from Hymans Robertson as actuary to the fund. They are probably the market leader for the local government scheme, and I feel that we're sort of well advised from them. And in terms of the process, that, as I said at the start, we're now substantially completed, and I'm very satisfied with the way things have gone. I think, unless there's any comments or questions on the funding strategy, I'll just turn to the two additional policies which are new for this valuation cycle, but maybe I'll just pause in case there's any questions at this stage.
David.
I guess with this, it's a sort of, you will have a number of people who were in the scheme or organisations within the scheme who've perhaps closed off contributions and made a change policy. So is that taken into full account in this? And how do you? I noticed that you had in the appendix thing. I think it was in. Oh dear, I've got to find the page number again now. You had a section on this, and I suppose it was just trying to sort of see how that plays out in the policy, I guess.
Yeah, thanks. I think it's a good observation. So for the majority of the scheme employers participating, we've got sort of 57, 58. The majority of those are open to new entrants, meaning that new joiners can benefit from the LGPS. There are several employers in the scheme who have made decisions entirely on their own grounds to close that scheme off to new entrants, essentially closing the access to anybody that would like to join. So that pool is essentially responsible for meeting the costs of. Actually, I highlighted it and it'll be page 52 of the paper. So this is back to the table in the funding strategy statement. There's a specific section that sets out the approach that will be taken for employers that are close to new entrants. So 6 columns across. And what you notice is that essentially there's a lower risk option there. The actuary isn't looking to penalise these employers, but essentially what it's trying to ensure is that they are sufficiently funded, recognising that they will, at some point in the future, a cessation event will occur whereby the last remaining active member will leave, whether it's through retirement or leave for new employment. At that point, the fund would be seeking to ensure that that employer was fully funded, that could meet all of the liabilities it had built up over the years of experience. And essentially, what we're making sure is that no other employer has to cross-subsidise that cost. And so the approach of the actuary is to take a more prudent view, take a lower risk assumption of them getting to that fully funded status, thereby not allowing the risk to flow. What I think, and we'll come on to this in the second part of this report, which covers 2 additional policies, is that over time the LGPS regulations and I think correctly, have afforded employers a little bit more flexibility to allow them to manage that cost as well as the fund. And I think what we've seen over more recent years is advisors to the scheme employers seeking to use those flexibilities. And up until now, I don't think we've had a clear policy or mechanism to allow that. So probably are sort of moving into the second part of the report now, but the intention is that we allow that flexibility, and also it sort of gives the fund a little bit more clarity around what it can and can't receive. Does that help?
John, any questions or comments on what Alex has said thus far? No, from me either then. So Alex, you continue.
Okay. So I think that's quite timely, really, moving into the second part of the report. So the bottom of page 44 of papers. In discussions with the actuary, for the very reasons we've just mentioned, it was suggested that we expand the policy essentially to allow or to set out clearly how we would approach the sort of several scheme employers who may need that flexibility around exiting the scheme. So this primarily is aimed towards those on a low-risk basis for now, but there could be some instances where open-end scheme employers are thinking about future arrangements of the scheme, and I think that would apply then. So it's a policy that I think is, although a new one, I think it will be in play for the long term. This has been drafted again alongside the actuary, so it's fully ensures it fully covers the regulations that are in place and all of the affordabilities. And I think really it allows it's the fund's discretion really to have a bit more flexibility in scheme employers. We started to utilise some of these flexibilities in discussions we're having this year, and nothing's really come to fruition yet, but I think we're getting to that stage now where we've got a clear route forward. So I think that's quite positive. I wasn't planning to cover the policy in detail. I think essentially it will be owned internally by officers, but again, happy to cover any of the detail if necessary. I think the final policy, and I'm referring to so midway down page 45 now, is a contributions policy. Again, in line, sort of in the spirit of the flexibilities, really. This is to ensure that we are very clear about when an employer could seek to have a review of its contribution rate. That's not necessarily saying we would allow a review of a contribution at any particular period. Typically, we would only look to do it every 3 years. The purpose being that we allow our employers stability, but also we look to a long-term funding model. But there are occasions, instances where employers may need sort of a shorter-term review, depending on something that may be going on within that organisation. So this just gives a little bit more discretion to the fund, a bit more flexibility that allows us to review that on an as and when basis. I don't think this policy would be overly utilised, would be my view. This would be the exception rather than the rule. But it is there nevertheless, just to give that comfort and the flexibility when we need it. I think probably the final point I would just draw on here is that this isn't something that the fund leads entirely on its own. We do, given the fact that it does affect all of our scheme employers in one way or another, we do have a detailed consultation process. So as part of the valuation exercise, when Joe and I issued the contribution results before Christmas, we also issued draft versions of all of these policies. We invited all of the scheme employers to review and comment on those, and we gave them a reasonable window, a time frame in which to do that. Some of them did come back and provide some comments, typically through their advisors, and it was typically the ones that were sort of maybe thinking about utilising some of the policies in the more near term. All of those comments have been reflected in the versions that you see today. I think the second point to say is that the key role of the Local Pensions Board is to oversee fund policy documents. And in their meeting in January, the board had an opportunity to review these policies in detail. And again, comments were shared, which we've reflected in the final versions today. So I'm comfortable that we've consulted appropriately. These reflect, I think, a positive update for the fund. It gives the fund a lot more flexibility in helping to support its members, scheme employer members, particularly with the current sort of affordability and cost of living pressures that they're seeing as well as society in general. So I think that provides some good flexibility. And I think unless there's any other comments or questions, perhaps turn to the recommendations, Chair.
Yeah, no, thank you for that explanation. I think it's very helpful, and I think it's very positive, obviously, to have this sort of level of flexibility that, should we need it, as it were. My only observation or question really was that is this very much in line with the other partners in the WPPP? I presume everybody's looking at this and there's a level of consistency. That's the only ask.
Yeah, and actually coming in, the only question I had was, what was the impetus for actually doing this? Have we been behind schedule with some other funds by not having these draft policies previously, or are we now sort of leading the way in ensuring that this is part of the the comprehensive set of policies we're looking to pursue over the next couple of years.
I think to the second question, I don't think we're behind the curve. The majority of the flexibilities in the regulations came in shortly after the 2019 valuation. So it's probably kind of, in terms of our typical timings of reviewing these policies, some of that sort of happened after we'd already gone through this process. There was an opportunity then to have done it, but I think and this, I couldn't speak for many other LGPS funds, but I know speaking to colleagues across Wales, some have opted to use this valuation cycle as a way in which to bring all of their policy documents up to date. I think just to reassure members that although we don't really have any instances where anybody's fully utilised the new flexibilities, where we've had conversations over the last 3 years, those have been in line with advice from the actuary, which reflects the flexibility. So I don't think there's any risk that the fund has not adhered to the regulations, despite not having a policy in place. To the second point, as I said, some of colleagues I've discussed across the WPP have been looking at this sort of flexibility. I can't speak for the sort of specific examples of whether they've had, employers approaching them with the same queries. But also just to reiterate that from a sort of an administration perspective, this is very much fund by fund, some of the decisions. So it's not in the same way as the WPP on the investment side is more of a collaboration. The administration is still at the discretion of individual funds. So we perhaps wouldn't necessarily expect all of that to move in the same direction at the same time.
Betty.
Yeah, I can just add that outside of Wales, the other fund that I advise has done this in the past in 2022-23, and that was actually motivated by a housing scheme that wanted to leave, was looking to do a merger and consolidation and these kind of corporate events provoking, a rethink, and so they had to get the policies up to date and especially develop these policies for, deferred payments and deferred settlement agreements and deferred debt agreements and stuff. So it's very much a live issue, which I think has come up in the past year.
Thank you. That's very helpful clarification. So, David, anything else?
No, Chair, that's fine.
John? You okay? Right. So, unless anybody else has any observations, Ian. Yeah.
So, my experience, just to add to what Betty said, is there are a few exceptional cases where people have done this in the last couple of years. But I think most authorities in England are just getting around to doing this now. So we're not out of line, we're not behind. This is happening everywhere at this stage.
That's what I'd like to hear. All right, then, moving on then to the recommendations on page 46. The first is that we note the update provided and consider the revised FSS together with the accompanying policies set out in the appendices, which I think we can take as read. And the second recommendation is that we approve the policies in accordance with the LGPS regulations of 2013 for publication to the fund's website as of the 1st of April. So, John, happy with that?
Yes, happy, thank you.
Excellent. We've passed that one as well then. So, thank you very much, everyone. Moving on, Alex again. Right. It's strange that. Item number 7, we've got our risk register update.
Okay, so typically the members would have seen a risk register update on each of the quarterly agendas. Just by the way of the background really on this item, the fund has maintained a risk register policy or a risk register document for a number of years, and this is very much in line with the good governance of local government schemes. In 2019, when I joined the scheme, one of my first roles really was to review and sort of update and refresh the risk register, and we've monitored that as a committee every quarter since. There's also the role of the pension board, which is to be satisfied with the risk management of the scheme, and I actually think that contributes very well in terms of the version of the document that members typically see on a quarterly basis. Following discussions at a pension board meeting in October, the board essentially presented 2 suggestions or recommendations to officers really to improve the process. The first was to prepare a risk register or risk management policy, and that actually set out the fund's approach to risk. The second was to review and revise the existing risk register document and perhaps make it a little bit easier for members' review. I think that comment was essentially, it's a very large risk register document, as you know, sort of circa 40 or 50 risks. A a lot to review during a quarterly meeting. So I think the intention there was not to sort of not to make it any less transparent, but actually to just present it in a way that allows members to digest the content and contribute more towards specific risks. So since then, I think just an update since the meeting that we had in October. As officers, we took that away and have prepared a risk management policy, which is pages 95 to 100 of the papers. And I think within that policy, what we've tried to set out is the philosophy from a risk management perspective, the process that the fund seeks to take in terms of managing risk. Also, critically, I think this is important to sort of to square the circle in some ways, is to ensure that the risk approach that the fund takes is aligned to the internal audit approach. So the fund is subject to the Torfaen Council's internal audit function. Broadly, they carry that audit out across admin, governance and investment functions, and they use the risk register as a way in terms of informing their approach. So that's now clearly set out in the policy. The policy also sets out how the fund monitors, or how the monitoring of that policy on an ongoing basis. So the suggestion we would review it at least annually. And I think also that it notes some key risks in terms of delivering on that policy, which key risks of a risk management policy, maybe a bit complex, but essentially that hopefully is clear in terms of reading the review. Just a final point on the approach there. So the pension board had an opportunity to review both the management policy, the risk management policy, and the risk register at their meeting in January. And any comments that were made at that time have been reflected in the final version of the document that is in the papers today. That essentially is the process. In terms of the recommendations, what we're asking of members today is to be satisfied that the risk management policy is appropriate and to approve its publication. And we suggest that then goes live from the 1st of April. And also the second part of the recommendation is to note the updates to the risk monitoring process, of which I'll touch on in a second. I think just in terms of the risk management policy, maybe pause just to see if there's any questions at this point.
David?
No, I think again you've explained it very clearly. I think I think it's positive that there was the opportunity for you to respond to the pension board's recommendations and suggestions. I always think it's a positive thing when you consolidate the risks and make it a little bit easier to understand. And I think actually again breaking them down into administrative, financial, etc. was also very helpful. So yeah, overall I would support what's been done.
As would I. John, any thoughts on what Alex has outlined?
No, it's very thorough, same as normal. Thank you.
In which case, I think members will be happy to accept this. Agreed. I don't know if Alex, you want to go through the actual register, if there's anything you want to highlight in particular.
Sure. I think maybe just a couple of comments on the review of the risk register document. Mm-hmm. So I think what we decided to do was to essentially create a two-tier approach. And what this was intended to do is provide a strategic register document, which is sort of around a dozen risks. The way that we would categorise strategic risks, essentially those that have the ability to disrupt the core services or could be particularly detrimental to them. And obviously, if you don't manage that risk, then we could have some sort of real long-term problems in terms of management of the scheme. Operational risks are exactly that. They're more day-to-day in nature, sit largely within the responsibility of almost entirely in the responsibility of fund officers. They would present challenges if they were to materialise, but I don't think they would have the overall impact, certainly on a time frame basis, that would overly concern us from that perspective. So I think the idea being that going forward we would present the strategic risks on a quarterly basis. Members would have oversight of that sort of dozen risk, and then at least on an annual basis, and this is something that I'm still sort of working with the pension board, but I think it was generally supported at their last meeting, that at least an annual basis members would have sight of the operational risks as well, an opportunity to sort of comment. Also, if there were anything sort of significant events or any material events that took place that warranted the need to bring the operational risks forward, we could also look to do that. So I think that's essentially the proposal here, is that going forward that would be the way we take it. And I think probably then, in terms of the actual document itself, page 94 of the papers, and this is without going into the sort of specific detail here and now, although more than happy to do so, I think what really came out of the review that we did internally was some duplication in risks, perhaps not surprising in terms of the number that we had in the approach. And so we proposed to remove 2 risks from the document. This actually sat within the strategic register, but what we noticed was that there was a lot of link between 2 in particular on each case. So we've made sure that those risks are comprehensive, but we've removed the duplication. I think the third point, and this was actually a risk score change, so this is more of an operational update, is in relation to ESG, so it's the Responsible Investment, Environment and Social Governance. And I think this was largely a recommendation of the Responsible Investor Working Group before Christmas, which was that although the risk is still apparent, given the work that's involved and the work that the fund is doing in this space, particularly supported by the Wales Pool, that actually the risk could would justify a risk reduction there, and so that is flowed through into the quarterly update. I should just emphasise that as part of this review, no change to the process in terms of the way that we assess risk and monitor has changed. This is purely a reporting change, and I think hopefully a positive one in terms of streamlining the process a little bit, giving members sight of what we feel are the most important areas, particularly for them in terms of the role that they carry out, but also not avoiding and ensuring that transparency by having the operational risks available at least annually, if not more regularly as required, and of course at the request of the members, we'd be happy to include that as part of the regular update going forward if it felt important. I think probably that's it, Chair, unless there's any other questions or any other thoughts on that document.
David.
Just to say that it is very helpful, as you've outlined at 6.6, to indicate where the risk change has happened and also where any new narrative has been put in place. It does make it easier for those of us who only visit this occasionally to see where the change is and understand it better. So thank you.
Ethan.
Just a quick thing, as we change the strategic risks, I think it's clear that you're not going to be putting too specific yearly performance in there. That was one of the things that was deleted. I think it's more of an evergreen type of document without needing to update it every so often, as long as our direction of travel remains correct. We probably don't need to go in there every year. So that's another positive change we've made.
No, I'd agree on that one. John, any thoughts on this? No. In which case then I will point you members to the recommendations on page 94 at 7.1. So it's recommended that we review the risk register policy and approve its publication with effect on the 1st of April, and that we note the extent to which the existing risk monitoring process has been reviewed by officers and changes proposed to the way in which risk is reported moving forward. I think we've reviewed that and we can agree both of those points. So the crucial thing there is actually that we're happy with the publication of the 1st of April. So thank you very much. Item number 8. Alex to kick off with contributions from elsewhere.
Thanks, Chair. And you'll be pleased to hear that I'll defer to our advisors for some comments during this item. You hear somebody else on the agenda. So I think I'll just highlight really the key points, and just to reiterate, this is the quarterly performance report that covers the period to the end of December 2022. We're obviously now almost through the first quarter of 2023, and although we'll touch on, I've got a few figures that I can share just to provide you with a bit of an update. But I think between Ethan's macro update and perhaps any comments Betty wishes to make, we'll hopefully give you a flavour of where we are into the new year. But I think just focusing on that final quarter of last year, the fund did have a better quarter, delivered just over 3.75% return, which was ahead of the benchmark, which is quite pleasing. In cash terms, that was around 140 million increase on the value of the fund, taking it back to about 3.6 billion. It was at just under 3.8 billion at December last year. So despite what was a very volatile year for a number of reasons, the fund is sort of making strides towards that sort of record high that it had benefited from the year previous. Page 124 in the papers just gives a sort of snapshot, if you like, of where we are as things stand. I'll just dwell on this for a second, because I think it ties to sort of some more recent developments and things in terms of fund activity, looking at the investment strategy. So, I say this table really provides a breakdown of where the fund is currently invested across all of the different asset classes, equities, fixed income, alternatives. That market value figure in the middle is the one I've quoted as of December, 3.6 billion. The final two columns here show the difference between how the fund is actually allocated as at that period of time, so as a percentage of the overall value of the fund, relative to the strategic allocation, which was essentially what the former committee agreed at the after the valuation process in 2019. So we're about to commence with an investment strategy review, which will again look at the strategic allocation on a forward-looking basis. But I think in terms of, and this doesn't actually summarise at asset class level, but what you would notice in terms of observing those two final columns is the fund continues to be quite overweight its strategic allocation to equities and quite underweight its strategic allocation to alternatives. That's something that we've been reporting into this committee and the former committee for pretty much the 3 years. Some of it has been driven in the early phase, I think, so particularly around the pandemic. Asset performance was sort of exceptional, if you like, and I think the value of our equity investments were sort of disproportionately increased and sort of increased the overall weighting. Some of that has had an impact there. But I think the primary reason for us not delivering is kind of the availability of the alternatives, which is a big section that was agreed as part of the last review for us to increase exposure. But I think for the reasons that we discussed it, particularly in our December meeting, we do now have, for the first time, I think, a clear way forward with that, and I would hope that we would start increasing our allocations almost immediately, if you like, in this financial year. I think probably at that point I may just pause and invite Aoife just to comment, and I think her report is in the appendix, but this will be a bit of a macro update, give you a bit of a perspective in terms of how things are, perhaps a bit of a recap on last year, but also as things are going in this year, and then also Betty to maybe make some comments on sort of things that she's seeing in the early part of the year.
Great, thank you. So I call this report Saved by the Ball because this is an example of just how some of the recession seems to continuously be something that we just narrowly escape, whether through luck or through just good fortune. And one of the recent factors is the fact that GDP growth has remained remarkably resilient, which is really a sign of just not only the UK's own economy, but the global economy has been more resilient than expected given some of the headwinds that it's facing. So in this case, it was the World Cup, which caused the spending on retail and hospitality to be higher than expected, and again, prevent that GDP from going negative. But equally, there have been other strokes of luck throughout the course of the year, including the warmer winter in Europe, which has led to there being less of an energy crunch, less of an inflation momentum. But the really notable thing that we've seen throughout the course of the year has been the swift reversal of some of the narratives that really prevailed at the beginning. Because the recession was widely anticipated, it was so widely anticipated that, in fact, the contrarian view that maybe it wouldn't be that bad started to come to the fore. So we saw at the beginning of the year indications that inflation was in fact weakening and that the Fed perhaps and the other central banks would not have to be as resolute in keeping it in check. So the Fed actually decelerated by increasing only 25 basis points, but Bank of England and ECB remained at 50. So this was the 10th consecutive rate rise and really an unprecedented rate of rate rising, which we saw last year in our portfolio took a toll in terms of the fixed income performance. It also put some strain on equities. But now we're starting to see that it's having ripple effects. And it wasn't mentioned in this report because it is so new, but the fact that we've had a bank collapse, the second largest bank collapse in the US, and the greatest one since the WAMU in 2008, we are now seeing that it's not just investors that were exposed to these bonds that were suffering this collapse in 22, but also financial institutions. So there is this ripple effect, whether this will be, in fact, that which breaks, that they said that the Fed will continue on its trajectory, or the Bank of England until something breaks, whether this is going to be that which causes this reversal in interest rate trajectory, we have to wait and see. But already we've had about two switchbacks in terms of the narratives for the course of the year. We had the first, there won't be a recession, things aren't too bad, inflation is easing and the Fed will decelerate. And the Bank of England may well top out at its 4%. Then we had a reversal suggesting, no, recession is still on the cards, inflation is still high. and now we seem to have had a reversal of that again. So it just basically illustrates how difficult it has been to map the economic backdrop as we move through this year. Another trend that we've certainly seen has been, unfortunately, a normalization of the conflict in Ukraine and Russia, in the sense that it's no longer getting headline attention, and we're also seeing China emerge from its COVID lockdown, and that's been a sort of more of a normalizing of the normal emerging market status, at least in terms of the global equity picture. So that was looking positive at the beginning of the year. So in terms of your equity performance, we did see, because of this somewhat sense of it being overblown, the recession risks, that equity performed quite well at the beginning of the year. There's been a bit of volatility in that, and we can expect quite a bit more volatility as we look to the second quarter, because of that kind of backdrop of financial uncertainty. Otherwise, hard data continues to be strong, and it does seem to be slightly at variance with the consumer opinion. The kind of hard data I mean are this GDP number, like we saw, which was quite robust in the UK and has really not been that negative at all. Also, things like employment continues to be very strong. Not only in the UK, but also the US, which gets more attention. But the UK unemployment rate, around 3.7%, it's not the kind of dire straits that we would have seen in previous recessions. So this suggests that the consumer could be supported. Furthermore, even though the mortgage rates are higher, certainly anyone refinancing will be acutely aware of that, we have to remember that not every homeowner is in a refinancing situation. It's not necessarily causing the type of strain that it might if it were more widespread. But we have seen already, even since just in the few days since this report was written, a softening of home values in the UK. So that's a sign that there is perhaps starting to bite. Perhaps the consumer is a little bit more under pressure. But this hard data has been positive, when the softer the consumer sentiment data has been negative. So that's when we think about this backdrop to where the UK is in terms of its place and where the economy will go from here. It's quite a murky picture remaining. We did speak, and Alex spoke in the report, about the strengthening sterling at the end of the year. That's been a little bit weaker, less evidence since the beginning of the year. But of course, that will have an impact on your global portfolio. You won't see that. You'll see a little bit of a decline to the nominal rate of return, simply because when you do it and revert back to sterling, there will be a currency impact. So continuing to watch that, but still believe firmly in the importance of global equity diversification. When it comes to your fixed income, clearly you took a hit on that in 2022. And as far as where we go from here, what I'm seeing in terms of the fixed income is mostly allocators suggesting that you don't have to reach for returns any longer in order to achieve the same returns, or reach in terms of the risk spectrum. There's still more meaningful returns available in fixed income today. Of course, there will be volatility as we look at some of the macro forces, but at that same time, fixed income is seen as a slightly more robust allocation today than previous, because it's no longer a drag on returns. It can actually present reasonably meaningful returns, particularly if inflation comes into check. Did a section on real estate here, just because, again, to kind of debunk some of that narrative out there around real estate being finished or a poor source of return. Clearly, everything's very nuanced. It's not the same as 0809. You will be building your real estate allocations, but it's going to be complex. There will be areas such as industrials, which have been frothy and have been strong, which should continue to remain strong. There should be retail, which will be experiential and more high-end, which will continue to remain strong, whereas the high street could remain under pressure. So quite nuanced, and it's probably advisable not to really paint any real estate with a broad brush. That said, because of some of this, two things. One is the fact that bonds are more attractive, and real estate might have been a bond substitute. We are seeing some real estate being forced to basically deliver before clients would rather invest in it. So it's been held to a higher bar now, given that bonds themselves, so-called lower risk bonds, are yielding something similar to what real estate can yield. So that's putting some pressure on these real estate funds. We're seeing it in the UK and the US, a bit of pressure on redemptions on the quarterly real estate funds, which we have to watch, because we never would have expected them to be used as an ATM or as the source of liquidity. Some investors clearly still do, but equally one has to be realistic about the liquidity features of real estate. Even liquid real estate is actually not very liquid. And the other important point to point out here is you will hopefully be the beneficiary of some forced selling going on elsewhere. It's not nice always to want to take advantage of others' pain, but there is some pain out there in terms of the defined benefit plans, which perhaps are, one of my clients, for example, is now over 50% in private assets as a result of the contraction in value. So under that pressure, they're certainly not buying more, and they're probably looking to sell. So you, as an entrant, into a relatively new entrant into the alternative arena, might have a benefit there. So that's just something to watch. In terms of where we are looking, what we're going to be focusing on, clearly this Silicon Valley Bank affair has sort of dominated now in terms of financial coverage and press. We need to see how that plane lands, if it does. We're talking about landings a lot in terms of landing the inflation plane and landing the economic plane, and how we have a soft landing or hard landing or no landing, which seems to be the norm, at least the new emerging possibility. No landing meaning the economy will continue on this sort of somewhat unsustainable high inflation, sort of exuberance without, and where will the Fed go from there? Now we need to know how things settle in terms of the financial institutions, because what I've been saying for months is that the financial institutions have been robust in this environment, and actually now that seems to no longer be the narrative. So it's certainly been a humbling time in terms of anyone trying to forecast or make sense of the backdrop. But I'd say that now all focus will be on that. But equally, we can't forget the kind of Main Street economy. We're looking at layoffs, we're hearing about slowdowns, we're not seeing defaults. And I think it's really important to bear in mind and remember that all of this noise in the banking sector is not due to corporate defaults. It's actually due to liquidity mismanagement on the part of one bank and perhaps some others who are stretching things because of where the interest rate trajectory had, how it had emerged in the background. It's not because of companies going bankrupt that banks are under scrutiny, but we may find that one starts to cause the other. In the fact, if bank companies can't get access to their cash, maybe that will cause them to have issues. So there's going to be an element of contagion that, if it's not contained, will be dangerous. So that's where we're watching. And then as far as the energy narrative, we continue to, and you have this very front and center in your policy in terms of your energy transition focus. It's not front page news, but it's still happening. We're seeing a little bit of noise around it, given energy security continues to be an issue and will remain so. We're not seeing the same kind of single direction commitment to a transition. We're seeing BP kind of looking at some of the mothballed plants in production, perhaps might be reopened. I've seen that happen as we look to focus on security, but we will continue. There's still commitment to the energy transition, even if it's getting a little murkier as ESG comes under scrutiny. So I'd say that again is something that we're going to have to watch quite carefully.
Thank you, Alex, and thank you, Ethan. That's quite comprehensive. I've missed the news about the SVB this morning. So over here, we've committed to fully fund the exposures, haven't we?
Looks like HSBC just bought it for £1. Yeah, that's it.
Like
yes.
£1?
So £1, yeah. But I mean, obviously, that's the distressed sort of value to BHS, I think, sold for the £1 as well. But there will be more fallout. But it's we've kind of seen this picture play out a little bit, of course, with Northern Rock and all the others back in 2008. And now we have, again, it's not dissimilar. We were just discussing from the LDI crisis here in the autumn, and that something that was so-called low risk, like a government, high long duration government bond, when the volatility kicks in, it may not be, it may well have mark-to-market losses, which can cause some present-day pain, even if it would have been okay if held to maturity. So there's definitely a complexity around that, and this is the fallout of this unprecedented 10 consecutive rate rises for the Bank of England. I think it's 9 for the Fed. I mean, there have been a similar, it's just we're trying to deal with how we deal with this.
David, did you have a question? Yeah. You didn't know, I thought you had your hand up. You don't have to. I mean, again, that was pretty comprehensive. I'm not quite sure what there is. I've got to. Any questions?
No, I think it was helpful to hear both reports. Let's say that first. And I think helpful, Alex, when you described the the things that we've perhaps not done so much of that we'd hoped to do so much of. And I guess one of the things that engaged my interest, simply because back on the 22nd I went to a seminar workshop on LA pension fund investment in affordable housing. So I was quite interested in the investment in real estate, as you call it, or housing and property, as we would have it here. And it'd be nice to see that there's perhaps some attention driven to that. I also found out that in fact, a London pension fund owns the Bronavon headquarters now. So it seems that we're seeing some investments happening, and perhaps this is something we need to be considering a bit more in terms of some of the kind of infrastructure opportunities. Maybe, this is just flagging a few little things, and I think that's all I can say at this point.
So on that, just for clarification, is it the London local authorities the combined pension London pension fund?
One of the London boroughs.
Oh, okay, that's quite interesting. Can't remember which one.
I've got it written down somewhere. But
Well, if you could, because it'd be quite interesting. If I know anyone, I will go and give them the lowdown on Bronavon.
But I don't know if there's opportunity just maybe to touch on, obviously, just for members' benefit, every quarter, myself, Lewis, our graduate, but also Betty, attend the vast majority of individual meetings with our managers. So just perhaps not make that crystal clear in the past, but we don't just take manager performance on face value from the custody report, which is in your slides today, is the independent report that is produced by Northern Trust. But also what we do is meet each of our managers on a quarterly basis and just have an opportunity to understand performance and also any sort of changes that they see. Ben, not wishing to put you on the spot, but is there anything that you wish to elaborate on, perhaps from the more recent meetings?
Yeah, no, it's very easy to make generalizations about the real estate market and interest rates rising and cap rates rising, but it was quite interesting to be on those calls and with the very well-known managers that we have, small pieces of publicly traded funds. It is true that if a lot of people seek to raise cash by selling interest in a portfolio of buildings, it is not like just selling shares or gilts. I mean, that's should have been obvious. And there's kind of a queue. That being said, when you listen to the managers' presentations, they're not just buying real estate. They're buying specific buildings. They're improving them. They have business plans, and then they cite certain examples which have been incredibly successful. But the right property, the right positioned, and there are still transactions going on, and there have been very profitable sales. So, like everything, it really gets to the benefit of active management and working with very, very skilled people who are, experts in their sector and don't go beyond a sector, becoming overconfident in something they're less expert at. And there another story in the newspaper that, because I tend to look at these funny stories that are not on the front page, but they're kind of more obscure. There is also a story about something called Home REIT, which did a lot of quote affordable housing, and there's kind of a scummy entrepreneur behind that. And you can just imagine this great investment scenario. Oh, get all this housing for people who will be homeless and who basically depend on local authority and state benefits. And by the way, the government stands behind that. The government's paying their rent, and the government will give you inflation-linked, rent increases, for the rest of time. And that sells very well. Well, actually, it does not quite so simple. And there is one story, and I'm sure this is not an isolated event, where people have actually not gotten, government not just sort of waved its magic wand and paid these ever-increasing rent increases, and they've tried to put through rent increases to the actual tenants who, of course, can't afford them, and then, of course, become either homeless, or this adds to their problems with their utility bills and their food and everything else, and it creates real social problems to people who are already vulnerable to begin with. And for me, this is really interesting because it just highlights how specialized and what careful handling this requires. I actually made the same point on a Room 151 panel about affordable housing. I mean, a lot of things get, labeled affordable housing, but you have to look very, very closely into what is actually going on, who is living here, who's paying the rent, can they afford it, how much can they afford, what's their source of income. This is like underwriting a mortgage. You've got to underwrite their ability to stay in their property and not be just stressed and at risk of homelessness. So I think there's a lot of interesting things to do, but I keep banging on. We need to work with very, very specialized people in this field who know what they're doing, because it almost borders on it's the next thing from social services. And as long as we have our eyes open, there probably are good things to do, but just something, it's just this label plastered on it. is either a scam or it's not going to be affordable for very long and it's going to cause more problems and there's reputational problems. So it's actually something I'm very interested in, but doing it right. And I would predict there will be, a number of things that looked good on paper, a few years ago that turned out to be a real problem and people maybe regret they did it. So like everything, Alex is a master of this. Don't race to get it done. Do it slowly and correctly. The same thing with the alternatives. It's probably turned out to be beneficial, actually, that we've taken our time and done it properly and now have cash to invest. Same with all these other, trendy things.
And it's quite timely, I guess, that obviously at the close of the meeting, we've got an opportunity to start thinking about the investment strategy and the refresh the next couple of years. So it's definitely the right time to think about the scale at which we pursue some of these potential proposals. John, you've got your hand up. You're on mute, though.
Sorry, yeah, I'm having a bit of trouble knocking my mic on and off. How worrying is it? You touched on real estate when you've got the world's largest alternative asset manager, Blackstone, limiting withdrawals. I saw that on the news and I thought that was quite worrying.
Yeah, I suppose it's a question of what's actually behind the headlines. And what that is, there is normally a limit on withdrawals from a fund like that of around 5%, just to manage the sale, avoid fire sale, manage liquidity, and protect the other investors. So it's usually a risk control measure. The actual withdrawal request was probably double that. So it wasn't like there was a 50-60% people trying to run for the doors on Blackstone. It was more that the normal quarterly withdrawal that they could match was probably double that they requested, but still not large in terms of the overall number. So in that instance, it's the prudent thing and the typical thing is to put up a gate in order to protect all investors. I don't think there's any indication there's anything particularly wrong with Blackstone. It was very large. It would be natural that it probably has the broadest, most diversified group of clients, which probably involve many of those that are trying to downsize their allocation to privates. So again, it doesn't give me too much concern because you always have to just read the numbers behind those headlines.
Thank you.
I think just to add a comment on that, because obviously we've had a lot of meetings with our real estate managers during the quarter, and I think it's fair to say all of them, or at least the vast majority of them, have been subject to redemption requests during that period. And I think Ethan made a comment about these open-ended, what would be deemed maybe liquid portfolios, but essentially have got up to 12-month redemption periods, and that's therefore their commitment is that they would return their capital to the investor within 12-month period, so they allow themselves that amount of time to realise it. I think what's reassuring is that all of our managers have been able to meet the redemption requests or in the process of meeting the redemption requests that have been made, mainly falling out of the liability-driven investment or the LDI crisis of the autumn of last year. As things stand, we're a long-term investor. We have sufficient liquidity within the portfolio. That means we aren't in a forced selling position by any means. There's no need for us to try and sell into a market that perhaps isn't desirable from that perspective. But I am comforted by the manager's approach that we've discussed with all of them, just to be satisfied with that.
Thank you, Alex. John, is that the same hand or is it a separate question?
I don't know what's going on with my hand. It says it isn't raised at the moment, so I don't know.
All right, fine. In which case, I think David, any more questions? Any observer with any comments or questions? In which case, thank you very much, everyone. I think it's very interesting again, and definitely some points. I know we've got discussion at the end of the meeting. I think it's very, very timely, and we'll be informed of some of those that discussion. So moving on then, item number 9. Luckily for Alex's vocal cords, it is not him. It's over to Joanne. Thank you.
Thank you, Chair. So this is the administration update. So the first part of this report just gives members a brief update on how Pension Online is going. So I'm pleased to report that we've now got 25% of our membership signed up to My Pensions Online. Considering we only went live a year and a half ago, I think that's really well. And we will hopefully have an increase in uptake in members around July, August time when we send out the annual benefit statements. So I'm hoping to get that number increased again this year. Point 5 of your report just provides members with a few updates on some of the developments that the fund has been working on over the past few months. We've been implementing some payroll enhancements, and these are going to bring a number of benefits to the pension fund. And I've listed the benefits under 5.2 of your report. These benefits are really going to enable the fund to reduce the number of manual calculations that they need to do and the amount of input that they need to do. As a result, then, minimising the possibility of any risk to the fund. So the next project the pension fund is working on is immediate payments. So this will enable the fund to make payments to members through the pension administration system rather than using the financial system, the council's financial system. So we'll be looking to roll that out now within the next couple of months, and it should make the process much more smooth and enable payments to be made through the fund system itself. Just touching on cyber security, so I continue to meet with our Chief Information Security Officer on a monthly basis to assess the cyber risk of the pension fund. And in December, we carried out our annual tabletop exercise with Hayward Pension Technologies. They're the company that provide us with the pension administration system. So there were no issues found, and Hayward demonstrated that they have all the necessary policies in place to handle a cyber attack. This is something that we've done. It's the second year that we've done this type of assessment, and it will be something that we'll be doing on an annual basis to make sure that the information that we hold for our members is secure. And then finally on the report is information to members about a consultation. So on the 10th of February, the Department of Levelling Up Housing and Communities published a consultation on changing the annual revaluation of the LGPS. So we've, on the 9th of March, DLUC responded to the consultation and they confirmed that they're going to proceed with these changes. What the regulation changes will mean will be that the annual revaluation will be moved to the 6th of April for the care revaluation. And as a result of that, both the annual allowance inflation and the care revaluation will use the same September CPI. The problem is at the moment is that the two calculations are using a different CPI, and if no changes are made to the regulations this year, then when we run the annual allowance, there could be a number of members falling into or exceeding their annual allowance, which could lead to a tax charge. So the government are going ahead with these changes, and they will take effect on the 31st of March. We sent correspondence out to our employers about the consultation, and we will have to inform our members about these changes because I believe they'll be considered a material change to the regulations, and as a result we have to let our members know. We're waiting for some guidance from LGA regarding that. So that's something that will be taking effect now over the next few months. And then just one final thing that isn't in the report, but I thought members would like to hear about, is regarding the pension dashboard. So the Pensions Minister has announced a delay in the planned timetable for the pensions dashboard. So the first employers were meant to go live the 31st of August this year, and that now has been pushed back. So we don't have any timelines as to when it's going to come into force, but we are aware that it's been pushed back. So the staging date for the local government pension scheme was the 30th September 2024. So we're unsure yet if that's going to be pushed back as well, or if they're going to try and recuperate some of the time between now and then. But we'll keep members informed. And we are still we're going to carry on working on our dashboard project, cleansing our data and make sure that it's all up to date in preparation for when it does come in. So I invite any questions?
Thank you very much for that, Lisa. Again, very, very clear and comprehensive. David or John, any questions? None from me either, so thank you very much, Lisa. That all makes perfect sense. Well, the question, has the government given any indication why it has delayed the rollout of the dashboard?
I think it was to do with the sorry. I think it was to do with the infrastructure, the IT infrastructure behind it, but that's as far as I'm aware. Yeah.
Thank you very much. Keep your microphone on, because members will be happy with that, to note that update. Yeah, great, fantastic. Item 10 is still Joe, it's the elected member training update.
Thank you. So members will be familiar with this report, and appended to this report is the pension fund training plan and your individual annual training programme. One thing I wanted to cover off in this report was the National Knowledge Assessment. So members participated in the National Knowledge Assessment a few months ago, and Hymans Robinson has now published their report, and it's available in Appendix 3 of your papers. So I'm just going to provide some high-level results from the report for your information. So 16 LGPS funds participated in the assessment, which includes over 200 members of their associated schemes. In total, there were 3 respondents from the committee and 6 from Pensions Board, and the overall average score for all members equated to 57.41%, so placing the fund 6th out of the 16 who participated. Pensions Committee performed strongly in financial markets and product knowledge and pension administration, while the Pensions Board area of strongest knowledge was pension governance and pension administration. But both performed, for both the areas with the least knowledge was pension accounting and audit standards. So Hymans were also able to benchmark the fund against the 16 peers who participated in the assessment, and the table in point 4.5 details how the fund's results compared to those across the average of all the funds who've taken part. The last pension committee also took part in this assessment back in 2020. So Hymans Robinson has been able to measure the progress against each area, and the analysis for that can be seen in page 9 and 10 of Appendix 3 of the report. And then finally, on page 13 of the appendix, there's a summary of topic areas that both yourselves and Pension Board indicated that you would benefit from for future training. So there's some clear themes in there, which will help us shape your training for the forthcoming year. So based on the back of the results of the National Knowledge Assessment, we'll be looking to develop the annual training programme for 23-24, and we'll bring this back to Pensions Committee at a later date. So I invite any questions.
Thanks again, Joe. Are officers happy with our performance in the test? In the test, I mean, we've had this conversation. We've had this conversation outside of a formal meeting, and I think, as all of us, bar John, were new this time. I think we found that the committee members, at least, found the level of detailed information. And this is something we discussed privately, so I'm not saying that you don't know. I think we will, if not overwhelmed rather. I think we found that the expectations of the level of knowledge we were expected to have in that short period of time was possibly a bit much. And I was laughing at the fact that what was the one we didn't do very well on? Pensions, accounting and audit, and it's like, yeah, well, I've spent 30 years trying to avoid that kind of responsibility, so it's no surprise really. But all seriousness, were you happy with the performance?
Yes, I think it's been very difficult for Pensions Committee in particular with this assessment because, like you said, you've only been in the role for a short amount of time. And I think when we have attended some meetings, I think that has been recognised across the board, not just, within Torfaen, but, elections going on across the country. So I think what it does is it gives us a good starting point. And this is something that Hymans will be repeating in 2 years' time. So I think it'll be good then, so we can see that the development of, of the committee and the board in the same way.
David.
Yeah, in some perverse way, it gave me some satisfaction. We had picked up something, and we weren't completely ignorant. But yeah, it came at quite an early stage in the period of time on the committee. I think 2 meetings, if that, probably about 2 meetings, wasn't it? I suppose, looking at the comparator thing that you pointed us to on page 184, it's pleasing to see that this pensions committee performed better than the last one on pensions governance and pensions administration, which are probably 2 of the key things in the bits you most influence. So I would like to think that you've had a positive impact in that area, because we've got to learn a bit more about some of the things like actuarial standards and financial markets and risk management and investment performance, because that takes time. So in some ways it perhaps reflects what we might have expected, but I thought was a bit more positive than it could have been. So I can't say that I'm going to be racing to look forward to the next questionnaire, but hopefully I'll do better.
John, anything?
Well, I used to work for the Borough Treasurer's Department and no Brewing, also the Inland Revenue. I've had 6 years on this committee and I still found some of the questions raised my eyebrows somewhat. So, I think there's still a long way to go. But, just keep at it, isn't it?
Joanne.
One thing I would like to mention as well, and the board mentioned this, is that some of the questions that were asked in the assessment and some of the ways the answers were phrased were sometimes a bit ambiguous. So I have taken that back to Hymans and hopefully we'll be able to work with them and have access to the questions early on as fund officers to help maybe drive the questions for the next assessment, because that was a feedback from the board, and I think probably the pension committee feel the same way about some things. So hopefully our input can hopefully help the way that it's presented and the questions are asked next time.
Jolly good. Either of you anything further to add? In which case then, so thank you very much, Joanne. Let's if I was happy to note that agenda item, we can move on to agenda item number 11, which is the date of the next meeting, which is the 5th of June 2023. This year is going by very quickly already. So with that then, I think we bring the formal meeting to a close. Sorry, yes, I haven't got them here. But we have the exempt. Help if I turned over on my page. So actually, we've now got agenda item 12, which is the exclusion of press and public. So to agree the exclusion of the press and public from the meeting as presentations and meeting papers are not for publication, because in accordance with paragraphs 12 and 14 of Part 4 of Schedule 12A of the Local Government Act 1972, brackets, as amended by the Access to Information Variation Order Wales 2007, brackets, it contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the council, and in all the circumstances of the case, the public interest in maintaining the exemptions outweighs the public interest in disclosing the information. So members, are you happy to agree to the exclusion of press and public? John? David? Thank you very much. I think I'm happy to allow members of the board to continue observing the meeting for the final item. Garrett, can you check that the recording has stopped before continuing?